All right, here we go. Okay, and I'm going to share. I'm going to endeavor to share. All right. Okay, so do this. Slideshow. Oof, no, not that. All right, slideshow. Monitor. Let's try that. See if that. Oh, other monitor. There we go. All right. Can somebody give me a thumbs up to say, yes, I can see everything. We're all good. Perfect. Thank you very much, Kevin. Really appreciate it. Okay, so let's get started. So this was the big night. We talked about income, right? There's all kinds of income, dozens of kinds of income that people can have that theoretically they could show up with. But reality is that most of our clients, they're going to have wages, they're going to have scholarship income. There's a chance that there's some small percentage of them that might have a like independent contractor income. Either they like drove for Uber or Lyft, or they worked at an internship where they got paid as a contractor instead of as an employee. Those are the big ones, right? And we'll see a few more folks that have some investment income, capital gains, dividends, mostly capital gains, people are trading. But those are kind of the main kinds of income. And the IRS test does have a bunch of other ones. There are a lot of the traditional kind of typical VITA clients are elderly retired individuals who have a lot of retirement income. So 1099-Rs, Social Security, that type of income and those documents. For residents, right, the great thing is that almost all of these types of income are going to have some sort of document associated with them. The software is designed for this. So if we put those income documents in, it's going to walk us through kind of getting it into the right place. So let's do that. And then we're going to move on to adjustments is what we're going to do next. So let's see, coming back to here, going there. Okay, so this was our big equation, right? We have income, we subtract adjustments, exemptions, deductions. To get taxable income, we take it times a rate to find tax, subtract credits and payments that have already been made or withholding to find out, like, is it a happy day, we get a refund, or not such a good day, we have to pay tax. So when we talk about adjustments, right, so this is money that you spent on something, right? And the government basically says, oh yeah, that's a good thing to spend it on. We'll give you some money off your taxes because that happened to you. And here's a list of kind of some of the most common adjustments that we'll see. And we're going to talk about them in a little bit more detail. Some of these have no changes at all. Some of them have no changes for 2025, but they will be a change for 2026. Some of them are brand new for 2025 for the OB3. Again, they almost all come with some sort of an income document, so that makes our life a lot easier. So let's kind of start walking through these. So as we think about the adjusted gross income, let's talk about like how that works. So it reduces the amount of income that somebody has. So they report all of their income, and then we have this set of subtractions that we can make from the total income to get what's called adjusted gross income. And there are quite a few places where we will use AGI or adjusted gross income as a reference number or for other purposes. So AGI is a common set of letters that you will hear. So as our adjustments go up, right, that makes a bigger subtraction, so we will pay less tax. It doesn't affect all taxes, but it'll affect income tax. So it won't necessarily affect like a Social Security and Medicare tax, which is self-employment tax. It may not affect some of the other taxes for non-residents as well, for income, for investment income taxes. So these adjustments are generally going to be reported on Schedule 1, where I have an example of, this is an old one here, but this is kind of what it looks like. And they basically will just reduce your income dollar for dollar. So if you had $20,000 in income, $300 in other deduction or adjustments, and this is kind of a list of other ones. Basically, we would add all of those up and subtract to find the AGI. We're not going to have to do that math, right? That's why we love tax software. But that is kind of how the math would work, is we just add all of those up. All right, so let's talk about some of these adjustments in more detail. So educator expense deductions for 2025, now this changes for 2026, but for 2025, this is still the old rule. Basically, an eligible educator is allowed to deduct up to $300 or $600 if they are both eligible as an adjustment to income. So this is for somebody that is in K to 12 as a teacher, instructor, counselor, principal, or aide, and they worked in that job for at least 900 hours during the school year. So we do occasionally see people that ask about this because we will have somebody that's, going to school to get a degree in education. And they say, oh, I was doing some student teaching at whatever school. And so the real question that we want to ask here is, all right, were you working enough during the year to meet that 900 hours, right? A typical standard work level for a full-time employment is about 2,000 hours a year. So this is somebody that was working full-time for at least half of the year or part-time for the entire year. The expenses must be qualified. So there's a list of only these types of things apply. Basically, ordinary and necessary expenses such as books, equipment, supplies, and other materials. It doesn't have to be required, but it does need to be related. So crayons and pens and paper and art supplies and popsicle sticks so you can construct things. All of those types of things would definitely be qualified. One proviso here, though, is if a taxpayer is homeschooling their children, homeschooling expenses are not considered qualified expenses. All right, there are some reductions. So if you have qualified expenses, you have to reduce them by the interest that you get on savings bonds, any distributions from a state tuition program, any tax-free withdrawals from education accounts, or any reimbursements that you get for them. So if, for example, you get reimbursed by your school or by an employer for that, then you would have to subtract that. You can't basically double dip or say, oh yeah, I spent this money, I can subtract it on my taxes and somebody will give me that money as well. So that would definitely be kind of double dipping. These sort of reductions in the educator expenses are also not common, right? So we don't really often see educator expenses, and then to see deductions in them even more would be unusual, but theoretically possible. But again, once again, right, this interest is going to get reported to them on an income document. Same thing for distributions from state tuition programs, so on and so forth. So, and reimbursements would show up on their W-2, likely under box number 12. So there will be documentation for all of this if it does apply. All right, the next adjustment is penalty on early withdrawal of savings deduction. So the idea, right, is a certificate of deposit. You say, bank, give me more money. I need better interest rates. And they will say, if you promise not to touch the money for a year, we will give you, say, 5% instead of 3%. Yay, that's great. And if you have to get the money back, you got to pay us a penalty of 3 months of interest. Sure, yes, whatever. And then it turns out your car breaks down and you really need that money. And so you say, okay, give me that money. And so now I pay, $25 or $50 of penalty for early withdrawal of my savings. So that's kind of what that scenario or what a possible scenario would look like where somebody might have that. If that were to happen, it would be shown on their 1099 INT. Box number 2, early withdrawal penalty. So super easy to find. You would enter whatever's in all of the different boxes. Remember that form might look a little bit different. And sometimes when they send us in a different form, they're only going to put a number if there is something there. So they might say box 1, $150, box 2, $10. Box 3, they don't even say box 3, right? They don't say anything else. They just say those 2 boxes. And that means all of those other boxes are blank, that there's nothing there. So in some cases, they will not give you a form like this. They'll just do line by line, and they'll only give you those lines when there actually is a real number. All right. Okay. So an example here, right, the taxpayer sort of did this, right? So they had $100 of early withdrawal penalty, but what if they say they have a different number than what the income document is, right? So in this case, all of those income documents, right, they are getting supplied to the client, and they are also being sent to the IRS, right? And so when somebody files their tax return, the IRS is trying to match those things, right? They say, oh, Wells Fargo said that we charged you $75 of early withdrawal penalty, and you're saying $100, right? And so they are going to generally take Wells Fargo's word the first time. So if you submit $100, they are going to change that and send you a letter saying, we adjusted your return. So when we use this, we're going to use the income documents that they provide us. And if that person thinks that that number is wrong, they need to go back to their bank and talk about getting it fixed. It could be that maybe it was part of a different calendar year. And so, yep, they really did pay all of that money. It just wasn't all in 2025 or for some other reason. All right. Alimony paid. So not very common, but there can be alimony paid. So if a married couple gets divorced and one spouse agrees on their legal divorce agreement to pay support for the other spouse, that is what is alimony. And generally, it's not going to be deductible unless for any decrees or divorces that happened after 2018. But we can definitely theoretically have some people that were married before then, although it would not be common. And there's a big list of requirements for it to be considered an adjustment or a deductible expense. So this is kind of the list. I'm not going to really go through it, but basically it's all of these criteria would have to be met. So if we ever did see any clients that had alimony, or if you had any questions about it, my recommendation, come back to these slides, come back to the 4012. This is not an area that had any significant OB3 changes, and you can look through those criteria and make sure, does it meet the eligibility criteria to be considered alimony? Can that person deduct it as an adjustment to income on their tax return? All right. There's a special line for it on the Schedule 1. They also have to have the Social Security number or tax ID number of the person they're making those payments to. And it has to be only for the spouse's essentially living support. It cannot be for the care of their children. So child support and alimony are two different things. All right. This. All right. There we go. All right. Moving on. IRA calculations. So, right, the government says, hey, we would love people to save for retirement. Let's give them some money off on their taxes, right? That's like every deal in the IRS these days. So, an IRA, so is an individual retirement account. The idea is that you put money into that, it stays and grows there, and you don't have to pay any taxes on it. And then eventually, when you retire, you take the money out and you pay taxes on it then. So the idea is no taxes up front, taxes later. There is another kind of an IRA called a Roth IRA, and that one is the opposite. The Roth IRA is pay taxes now, and then you put the money in and it grows and grows and grows, and when you take it out, no more taxes for you. You don't have to pay any taxes. So that is kind of the two versions of it. Pay taxes now with the traditional IRA, or pay taxes later with the traditional IRA, sorry, or pay taxes now with the Roth IRA. You can't contribute unlimited money to these, unfortunately, right? So there is a set limit on this, and that limit is up to $7,000 that you can contribute and you can deduct off of your taxes. You also cannot contribute more than your yearly compensation. So if you only receive $5,000 in wages, then the absolute maximum you can contribute would be $5,000. There's a deduction or a subtraction for this, once again, on Schedule 1. Not a very common thing that we would see, but that happened. That could happen, the IRA deduction. What is a little bit more common is actually the student loan interest deduction, because we do see some of those folks. So they would have gone to school for undergraduate, taken out loans, and now they're perhaps coming back getting a master's degree or a PhD, and they're making payments on their student loans. And so they're paying some interest on those student loans as well. So that can be deducted it's called a student loan interest deduction, but it is an adjustment technically. So they can subtract up to $2,500 per year for the year that they paid the interest. They have to be legally liable for their loan. So like if you pay like a friend's student loan payment, they can't deduct that interest and neither can you. The taxpayer cannot be married filing separate, so they have to be filing a joint return if they are married. They can't be claimed as dependents. They generally will have a form from their lending institution or be able to look it up. And it's called a 1098E. So that is the form that they would typically have. And it will say, yes, so-and-so has subtracted or paid us this much money, and this is the amount that it was in interest. There have been a series of, I would say, pauses on student loan payments that kind of started during the pandemic. And that really kind of came to an end starting last year timeframe. So this definitely may be something that we see a little bit more of because for a long time, people could pause their payments, and those pauses have to a pretty large extent mostly ended at this point. All right, additional adjustments, right? So these are some other things where you possibly might see them. Line 12 are certain business expenses of like reservists, like so Army, Navy Reserve folks, performance artists, and fee-based government officials. That would be crazy. I don't think we've ever seen one, but those theoretically could happen. Health savings accounts, we do see a few of those every now and then, right? If you contribute money to your health savings account, like separate from whatever your employer takes out of your paycheck, then that would be a deduction. You don't have to pay tax on that money. You can save it away. Moving expenses for members of the armed forces, that is going to be out of scope for us. We do not do military service. Self-employment tax. So the tax for Medicare and Social Security, you can subtract as an adjustment to income half of that self-employment tax that you pay. So the software will do it for us. We don't have to worry about it, but that is an additional adjustment, just so you know. There are also some retirement plans that would be adjustments that would be allowable, but are also out of scope for us. Likewise, a health insurance deduction. So again, these would certainly not be common for us to ever really see other than possibly that health savings account. And when somebody has one of those through their employers, the money that goes straight from their paycheck, straight into that health savings account, that gets reported on the W-2. And so when we enter all of that W-2 information, that's all going to get transferred over properly. We would only have to do like an additional entry if they sent in some extra money outside of what was taken out of their paycheck. All right, and here's going to be some more. So in terms of the health savings account, right? So just to explain a little bit more detail about what these are, right? The idea is that reality is that healthcare is very expensive in the US. And so this is a savings account that's designed to help people save for medical expenses. So sort of like a retirement account, but this one is for medical expenses, not getting older and wanting to not have to work. So here there are a few requirements. So you have to be covered by what's called a high deductible healthcare plan. So there's a big amount that you have to pay before the insurance starts to kick in and pay for any of your healthcare. And usually that number is in the 3,000, 5,000 kind of a range. So it's a pretty big number. They can't be covered by other insurance or covered by Medicare. They can't be eligible to be claimed as a dependent on another return. Married individuals cannot have a joint health savings account, but expenses can be for either person. So if you're married and your spouse breaks an arm and you pay for that out of your health savings account, that would be a qualified expense. There is a limit on how much money you can save every year. For self-only plans and for family plans, it's kind of based on how many people are on the plan and then also your age. There's like some extra money if you're older. The one good thing about this is you can kind of decide at the end if you want to contribute. So you can't actually make a contribution after the end of the calendar year, as long as it's done before April 15th or you file your tax return. All right, this is the deduction. So if you make a qualified deduction, you can subtract that as an adjustment for your income. Again, this is what I talked about, right, for the W-2, right? That's already going to be on that W-2. You don't have to do anything more about that. The Form 8889 basically has a little bit of additional information about that taxpayer's HSA. It can also include some information about additional contributions. And then you also have to ask if they took any money out, right? Because the money that comes out needs to be spent on qualified medical expenses. If it's not spent on qualified medical expenses, then there is a penalty for it, an additional 20% tax. And what is allowable and what is not is moderately generous. I believe the 4012 has a list of those. If not, then certainly just a quick Google IRS Form 8889, that would take you to the list that would show you like what are qualified expenses or not. I believe that starting in next year, it's going to include some things like gym memberships, which are not currently allowable. But for this year, at least, I think gym memberships are no longer or not yet approved as an allowable expense. All right, self-employment tax. So, right, when you work as an employee, you pay Social Security and Medicare tax, right? Old age pension, old age medical insurance. You pay half of that money and your employer pays half of that money. When you work for yourself, you have your own business, right? There's nobody else paying the other half, right? You get to pay both of those halves. Self-employment tax is based on that total income, and essentially that one half, like the employer version of the half of it, you can subtract that as an adjustment from your income. The software will do all of the math for you to say, oh, this is your business, this was your revenue, this is your expenses, here's your net income, here's your self-employment tax, and here's the adjustment for that. So you won't have to do any of the math. You should just know that the software will and should be doing that for you. All right. If you are self-employed and you have health insurance, you can also subtract those as an adjustment to income. So the cost of those, including all out-of-pocket unreimbursed Medicare, private or long-term care premiums for yourself, your spouse, and your dependent children, can be used. However, if you purchased a marketplace plan and you qualify for a tax credit, that return is out of scope. So basically the idea is that for some of these things, right, like the Social Security and Medicare taxes and the health insurance, if a business were doing these, the business would be able to subtract those as a qualified expense and they wouldn't have to pay tax on them. And this is just another way that the IRS is sort of trying to balance the books out for people that are self-employed and working on their own versus people that are employees and the businesses that are being kind of run independently. All right. If you're eligible for an employer plan, you basically can't deduct any premiums. You have to show a profit, right? If you don't make any money, you can't like subtract everything, not make any money, and then get an extra subtraction on top of that. So, right, the whole idea, the IRS does not go along with the double dipping of things. If you're itemizing and you meet the medical deduction threshold, you can't double enter those expenses as well. So the idea for that, we'll just get to that in just a little bit. I'll come back to that when we talk about itemized expenses or itemized deductions. All right. Oh, I forgot my big orange splat. All right, so we have a new car loan deduction that is new as a part of the OB3. So on the idea for this one is that congratulations, you bought a car and that car was American made or at least American assembled here in the United States. It's got some other requirements about how many wheels and how big it is. It must be for personal use. And if you bought that new car and you took out a loan to buy that new car, up to $10,000 of car interest loan that you paid can be deducted as an adjustment. There is a VIN number that's going to be required, so we're going to have to report on the car identification number, essentially. And there should be an interest paid statement that will be issued by your lender. Now, this is probably one where like the IRS desire for like a customized income document that says, hey, this is what it should be, and here it goes, probably or may not be consistently executed this year. So it may be that the people have, random statements for the year-end statement that shows like, this is my loan and this is how much interest that I paid. So this is one of the areas where the exact details of the process are a little bit, I would say, TBD or being worked out. Hopefully being worked out now that everybody is back working at the IRS. All right, this is what the draft form looks like. Again, it is only a draft form. We don't really have any additional information other than, the vehicle number needs to go here and the interest that they would have on the loan. That's Schedule 1A. That's our adjustment that we would have it. If the car was owned for a business, that's the Schedule C, E, or F. And then math about how much gets added in there. So that's kind of what that looks like. All right, so let's do a couple of adjustment knowledge checks and we'll keep on rolling. All right, so let's talk about Pat and Chris. All right, so they're married, they want to file together, which is great. They have no children. Pat teaches 3rd grade at an elementary school. She spent 1,400 hours in the classroom, so she definitely meets that 900-hour mark. Chris is a social services case manager for a nonprofit. They had $60,000 of income and $2,000 of investment income from a certificate of deposit. So that's interest income. And they cashed it in 6 months early because they had to buy a new air conditioner for their home. All right, so they have these following things that they say, can we please get any money off of our taxes for these? All right, we had $600 for Pat for classroom expenses, $2,300 for a student loan for Pat, $1,700 in student loans for Chris. Chris is covered by a high deductible plan. He had $1,200 in box 12 with the code W, which is for the HSA. Pat contributed $1,000 for a Roth IRA. And they also had a $200 early withdrawal for that penalty for when they took out that CD because they had to buy that air conditioner. All right. So let's do this. Why don't we just use the chat? So if anybody is feeling brave, why don't you give me a letter, A, B, C, or D? What do you think that the total amount of adjustments they should report on their tax return are? I will give everybody a few minutes. I will think about this as well. All right, let's go on to the next slide and we can talk about it. Okay, so the answer is 3,000, which is nowhere near as much as it seems like it should be, right? It completely sucks, but it's still 3,000 they don't have to pay taxes on, which is better than nothing for sure. So how did we figure that out? All right, the first one for Pat, right? She only gets $300 in expenses as an educator, right? She's the only one that worked as an educator, so she only gets $300. If Chris had also worked as an educator, then it could have been 600, but only Pat worked as an educator, so they only get 300 bucks. That $2,500 student interest loan, that is a combined maximum, not a per person maximum. So even though they spent, what was it, $4,000 or something like that, they only can subtract that $2,500 for their student loan interest. And then they get that $200 early withdrawal penalty on their certificate of deposit. So that's where that $3,000 come from, right? The extra classroom expenses, I talked about that. The W-2, that HSA contribution, that is non-deductible HSA contributions because it's already been adjusted for in their wages. So they can't take like a second subtraction for it. And then his IRA contribution, he did a Roth IRA, remember, which makes that a taxes upfront, no taxes later. So he doesn't get to subtract that $1,000 of adjustment for his IRA contribution because he did it as a Roth IRA. So if he'd done traditional IRA, he would have gotten that $1,000 off, and he would have had to pay tax on it then when he took it out when he retired. Okay. Does anybody have any questions on that before we continue on? All right. I'm going to keep rolling then. If you do, please, you throw them in the chat or raise your hand, and I will be happy to stop. Okay. Just as an FYI again for this, right? Remember, when we look for resources out on the web, if we don't have anything like looking in front of us, like the 4012, right? The IRS website is going to be our primary source of where we're going to look to go, right? We're not going to use AI, intelligence, chat GPT, any of those things, because we have no idea what they've been trained on, what they've used as reference information. There are a lot of examples of incorrect information from chat GPT being used in legal cases where it turns out that information is not correct. So we want to make sure that we do not do anything like that as well. All right, so we were here, we've done income, we've done adjustments. So our next subtraction is deductions. All right, so remember the people that we help, right? They don't have to pay taxes on all of their income, even though it may feel like almost all. It's not necessarily all of their income. It's only going to get paid on taxable income. So we said total income, everything minus adjustments was adjusted gross income. Now we take adjusted gross income and we subtract deductions and we get taxable income. Once again, it doesn't mean that it's not going to be taxed. It just means that the income is reported on the 1040. So again, those are kind of some common phrases. Adjusted gross income, AGI, taxable income. Usually doesn't get abbreviated, but taxable income is another one that you'll hear. All right. So total income, we add up all of these things. When we look at the forms, right, that whole top section, all of these different places where that income might show up. We subtract our adjustments, then we subtract our deductions, right? And when we look at deductions, there are kind of two options. There are standardized deductions, and then there are itemized deductions. And once we subtract those deductions, we'll get down to our taxable income. All right. So for deductions, right? Once we get that, the taxable income, that is where we start to do the math to say, all right, taxable income times 10%, 12%, or whatever bracket you fall into. When we look at the deductions, again, there's only two of them or two options, standard or itemized. You're only going to ever use one of those versions. You're not going to say, oh, I'm going to take the standard deduction, then also this itemized deduction, right? It's only one or the other. The software does help us a lot, right? If somebody has all of these deductions, they say, oh, well, I don't know what's going to be better for me. Say, that's no problem, right? Let's just enter all of the stuff and the software is going to do the math to say what is best. And you can choose, right? If the standard deduction is the better one, then you can choose the standard deduction. Except in a few tiny little pieces where, for example, if you're married filing separate, and one taxpayer is required to itemize or does itemize, then the second person must also itemize. So this can sometimes catch our international student filers, where if they're married to a resident, they don't want to file a return, so they're filing separately. Then if the spouse that's a non-resident files, he's itemizing, then that means the resident spouse has to do it as well. So generally, I would say that almost all of our clients will be able to take the standard deduction, and they will do that because that is the most financially beneficial option for them. So again, right, simple chart, right, choose which one's best. That's all good. All right. So the standard deduction, right? It's a set dollar amount. That's why it's called standard, right? Now the amount itself varies based on your filing status. If you are over age 65 or you are visually impaired, you also get like an additional bump in the standard deduction amount. Generally, individuals that qualify as somebody's dependent can't take the full standard deduction. All right. But for most folks, most of the folks that we help, they can, and this will be the best thing for them, right? If you remember, I think this is one of the ones where I showed you these two charts before when I talked about the OB3. Basically, the 4012 currently has the incorrect charts saying, oh, if you're single and you're under 65, then file if your income was at least $15,000, which is that standard deduction. The new updated information says, oh, if you're single, then your standard deduction is $15,750. If you're over 65 years old, then you get an extra $2,000 of a standard deduction, or if you are visually impaired. All right, so it's a super good little bit of an increase there, basically. All right. Again, kind of standard deductions versus 2025 values. So the main thing here to know, right, is that if you are over 65 or blind and your status is single or head of household, each one of those gets you an extra $2,000. If you're married filing joint, qualifying surviving spouse, or married filing separately, then it's $1,600 for each taxpayer that applies to. All right. For somebody that qualifies as a dependent, right? So this could actually be a decent number of our clients because they're students, right? And their families may be supporting them. They may be providing, almost all of their income and their support for paying for tuition and rent and food and all that kind of stuff. So an individual who qualifies as a dependent, their standard deduction is the greater of either $1,350 if all of their income is unearned income plus any amounts for age or blindness, or the sum of $450 plus their individual earned income up to the standard deduction. So the idea is, let's say, for example, I work on campus, I have a job, I don't earn very much money, right? It's enough to pay for going out to see the movies and maybe a fun spring break. I earned like $6,000. So my standard deduction is not going to be the $15,000 because my parents can still claim me as a dependent. It is actually going to be $6,450 because it's my earned income, $6,000 plus $450. If I had earned, let's imagine I had a fabulous internship over the summer and I earned $20,000, even though I could still be claimed as a dependent because I was going to a really expensive school and my parents were paying for everything, right? Then my standard deduction would only be that $15,750 because it can't go over kind of that standard amount in the tables. All right. There is a new senior deduction, so an additional $6,000. This was the whole sort of how they figured it out for the no tax on Social Security, as they basically said, okay, here's an extra $6,000 you don't have to pay any taxes on. So this applies for taxpayers who are 65 or older. The taxpayer and the spouse must both have work authorized Social Security numbers, so an ITIN would not qualify for this deduction. They don't have to have Social Security income to qualify, right? It doesn't mean they have to be actually receiving Social Security. It just means that they are 65 years or older and they get this additional amount. The crazy news, right, is that this actually applies no matter whether they use the standard deduction or whether they itemize deductions. So this is a little bit of new territory from that perspective. It does phase out if they earn a lot of money. This probably won't be much of a problem for us because our software pegs out, like the software has a hard income limit. Last year it was $84,000. This year, they haven't announced the numbers yet, but it'll probably be in that same range. So theoretically, if we have a taxpayer who's over age 65, and earned more than $75,000 and came to see us, then this would apply to them. This phase out where they say, oh, you don't really get 6,000, you get 5,500 or 4,200 or whatever it is. The system will do that calculation automatically. We're not going to have to do that, thank goodness. All right. So that's the standard deduction. Super simple, set amount, boop, off the top, there it goes, and we move on. However, for some people, right, if they spend money on certain things, they can subtract that from their income as itemized deductions. And you can always choose to itemize. You can almost always choose to take the standard deduction, but you can always choose to itemize. All right, again, right, this only applies to a small number of clients because of all of the changes and the continuing increases in the amounts. Usually it's going to be for people that have their own house. Occasionally it can be for a few other folks. So the idea, right, for itemized deductions, you spend money on certain things, you can subtract some of that money on your taxes. So, right, buy a house, go to college, all that kind of good stuff. That's where these things start to fade in. So those types of expenses are, so medical and dental expenses. So there is a minimum amount here. I believe it's 7.5. Do I talk about it? Yes, I do. Let's talk about it. I'm going to go through them here. All right, so this is a list. We're going to go through them in more detail. So for medical expenses, so the idea is, right, say that you were in a car crash. You were in a horrible, horrible car crash. You had, a couple of months in the hospital. You had all of these huge medical expenses. You can subtract as an itemized deduction the amount of your medical expenses that exceed 7.5% of AGI. So this will include like doctor bills and dental bills and prescriptions and hospitals and all of these things. It doesn't include, you can't subtract here also ones that were subtracted as an adjustment on your itemized or on your schedule 1. So if you're paying for like health insurance premiums directly, you can't subtract them as an adjustment and also as an itemized deduction. So probably, right, you would say maybe in a good year when you're not actually in the hospital, you can take those as an adjustment and then take the standard deduction. Maybe that would be better. So medical expenses, not common, but every now and then we'll see somebody that has had something horrible happen and they would meet this requirement. Taxes. So if you have to pay state taxes, state sales tax or income tax, you get a little bit of break and they say, oh, okay, you don't have to pay federal income tax on the money that you send to the state or that you send to a local government. So like the city of New York, if you lived in New York City. Local or foreign income taxes are generally foreign in particular is out of scope, except those that are already provided on a 1099 INT or DIV. Real estate taxes also count. So if you buy a house, you pay generally real estate taxes. If you have a car, you will pay like a registration tax on the car. That would also count as a personal property tax. So there was a big change here in that prior to 2018, the amount for taxes was unlimited, right? So if you lived in a really high tax state and you spent, $25,000 on state tax and you bought this like super fabulous house and you spent like $100,000 on property taxes, you could deduct all of that from your income taxes. And then in 2018, they put a limit on that. And that limit was $10,000. And so people that were in these really expensive states were very unhappy because all of a sudden they could no longer adjust all of this, subtract all of these expenses. But back in 2025 now, here we are in the future, and they have changed the limit. So it's no longer 10,000. It's not unlimited, but they've bumped it up to $40,000. So if you have a house and a car and all of this stuff, then it may now be much more possible for you to take itemized deductions if you're paying a lot for those. Whereas before, with your state, local taxes limited to $10,000 and a standard deduction, like if you're married of like 29, 30,000, it was really hard to get over that standard deduction amount. All right, so when we look at this for homes, like some of these itemized deductions, so home mortgage interest, it's the first and second home only, just in case anybody out there has more than one. Private mortgage insurance is back as an interest deduction. For reverse mortgages, no interest until the loan is settled. That's basically when you essentially sell your house and you're living off of the payments. Cash or non-cash deductions to a qualified charitable organization count, right? So those can be limited by Vitascope. If you give money to a charity, then you can subtract that as an itemized deduction for 2025. It's going to change in 2026, but for 2025, there is an itemized deduction. If it's above certain amounts, there is additional paperwork that you need from the organization that you gave that money to. And if you donate things instead of money, and so when I say money, we say like cash or a Venmo payment or PayPal or like a credit card where you donate to somebody, click on a website link and donate some money. Those things are all money. But if you donate like clothes or a car, those are things that you donate. Those have to be valued at the fair market value of them when they were donated, right? So it's no longer brand new clothes that you paid $500 for. It is used clothes that are now worth maybe $50. And vehicles are a whole big thing, and there's a special form that needs to come back from the charity on those to help value them. There are some miscellaneous deductions as well. Gambling losses up to the amount of winnings. I think that this is wrong. I think that this is maybe now 90% of gambling losses. So I will try to check on that and give you guys an update next time. But I believe that one has changed now with OB3. The most miscellaneous deductions have all still kind of been eliminated. Work expenses are allowed for a disabled person only as well. So the idea is, right, if you out of your own very own money had to buy like a uniform to work at your job, you used to be able to deduct that. Now, generally, that's not allowed except for certain individuals. Sometimes there can be casualty and theft losses. So if you were in the hurricane and your house was destroyed, then you can deduct losses associated with that. It's out of scope for VITA, but if we do find anybody that's in that, just know that that is the case. I think we had a few from Hurricane Helene out in North Carolina in the prior year, but generally it's not a big issue for us, and we can't help them at that point. They're going to need a professional to help them with that part of it. All right, so coming back again, right? Taxable income, right? What you pay taxes on is not all of the income that you receive. You take all of the income you receive, you subtract adjustments to get adjusted gross income or AGI. From AGI, you subtract your deductions, whether it's your standard deduction or this list of all of these itemized deductions to get your taxable income. Only one of those two things, standard or itemized, can be applied. Generally, you're going to choose whatever is of the highest value unless the taxpayer is required to itemize. All right. And the software will do the math for us on this, right? So you could go in and you could put charitable contributions and you could put, student, I'm not going to get that right, real estate taxes and taxes, interest paid on a mortgage. You can put all of that information into the software and it's going to do the math to say, oh, we think that, the standard deduction is still the best option for you. That's perfectly fine. Let's save money. All right. Okay, so those are deductions. Does anybody have any questions on those? All right, so I would say we're well into the upper 90s in terms of our typical clientele taking the standard deduction. So maybe it'll change a little bit this year, and maybe we'll be at like 95% or something like that. But I do expect that we're going to see um, the vast majority of people still taking the standard deduction. Okay, so the last thing that we're going to do for today is to try to like see this in action. All right. So like I mentioned in the past, right, for non-resident taxes, the software, we can make it work, but it's not really our friend, right? We just like, we're neighbors that we kind of like wave at each other when we walk by, basically. Whereas for residents, right, this is like the TaxSlayer is our buddy and it's going to help us make it through this process. Now, recognize that like right now, TaxSlayer is in the process of being updated, right? So they are desperately trying to get all of the information they can from the IRS about like, okay, how is this, no tax on car loan interest thing supposed to work? And like, are the forms finalized? And how does the math? So they're in the process of updating everything. So for the moment, right, we know that the TaxSlayer calculations are a bit sketchy. But as we get through the end of the year, as we get into the filing season, right, like this is the real stuff. This is what's going to be used by all of millions of people. And the software is going to do the math correctly. We're just kind of seeing them like before they're really ready to go. Okay, so we are going to go here. All right, we're going to go here. So I am going to bring this over. All right, so this is the website for Link and Learn. And I just bring it up because that's my easy bookmark. And it also has a link to the practice lab right here. So the links to practice lab and the links to Link and Learn are going to be out on the Moodle course. So everybody's going to have access to those. So when you go here, you're going to click on it. All right, and this is a 2-password system. So the first password that you enter is all capital letters, TrainProweb. So Train Pro Web. And then you will enter your own username and password. When you go in the first time, you're going to create an account, enter your email, username, whatever you want it to be, password, whatever you want it to be. You're going to select a VITA site. And you're going to put in S300 92021. So all of the tax returns that get prepared at our sites, they have this SIDN number, site identification number. This way, the IRS knows how many people we helped to file a tax return. And they use that for their reporting and for our grant reporting as well. So when we say, hey, can we have some money so we can have Moodle software and things like that, this is what they base it on. You'll select some sort of a security question, all of the typical ones, and then a security answer as well. So I don't need to create an account because I already have one. So I will log in and it will take me in. So this is the practice lab here. These are a bunch of videos. If you are feeling very motivated, you would be welcome to look through them. This is kind of training on using the software. We as FSA volunteers, right, we are not using this software to that same degree, right? We're not going to be entering clients' information, right? They're going to be entering it for them. Now, we're going to get a lot of practice in doing it because we need to be able to fix whatever they've done. So in some ways, you've got to be maybe even more of an expert because you're trying to diagnose their problems while we're partway through the tax returns. But for now, just know that this is all here. Their 1040 NR thing is terrible. Don't bother with that one. But let's go to the practice lab. So this is what the software looks like. So what we would do here, I'm going to come back to our thing. So Train Pro Web, I walked through that, create an account. There we go. Go to the practice area. All right, this is obviously an old one. We're going to start a return. And we're going to create a fake social security number. Now, one really important thing to know, right? So this is the practice laboratory. So it is not live software. You cannot file a real tax return through this software. So no matter what you do, you are not going to create any problems for anybody with anything that you do in the TaxSlayer Practice Lab. It is all not real. It's a sandbox. So we'll do fake social security numbers. We'll do lots and lots of them. We're going to do the basic profile and start a return. All right. They should give you a warning that says, hey, it's not right yet. You're going to select the filing status. They have this lovely little wizard that works for all of the resident options. It doesn't work for a non-resident, but it works for all of the different resident options. And so that's what we're going to do. So we're going to do a simple student. So let's look at him really quick. All right. So we have Jacob. So Jacob is a sophomore at App State studying history. He's single. He was born January 1st, 2004. He is a US citizen. His parents live in Charlotte, North Carolina. His parents are paying for all of his school, his tuition, his room, and his board. They are claiming Jacob as a dependent on their tax return. But Jacob also worked just a little bit on campus because he wanted some spending money. He had plans to go to Mexico for spring break. He needed to earn some money. And this is what he earned, right? So this is a W-2. This is a semi-realistic W-2 that has this is the actual form, what it would look like. That is the real employer identification number for App State. Obviously, that's a fake number for Jacob. And the rest of the stuff is pretty good. So let's prepare a return for Mr. Jacob. So I'm going to move this to the side so I can still see it. And then we're going to do it. So I am kind of double screening things. If you have a big screen, you can side by side like this as well. I think it does make it easier to do. If you don't, then you can just make everything big and then kind of do the Alt tab to go back and forth between them, however you like. Print it out, whatever works best for you. Okay, so we're gonna do Jacob as 2100210. All right, basic return, here we go. All right, so let's do it. Okay, so let's look at the filing status wizard. All right, were you married on December 31st of 2025? And our answer is no, right? Ooh, maybe they did fix this. Were you a citizen or resident alien? Yes, I'm going to totally play around with this some more. Have you ever been married? Nope, Jacob's never been married. Do you pay for more than half the cost of keeping up the home where you lived? No, right? His parents pay for that stuff. You don't have a qualifying person? Sure. Did you pay for more than half of the cost of keeping up the home for your parents? No. Nope. All right, based on that, you should be single, which is great. So we're going to select single here. All right, note to self to come back and play with that more next time. All right, so we've said single. I'm going to make this a little bit bigger. Hopefully, if this is too small still, please let me know and I can make it a little bit bigger. Jacob Miller. Jacob does not have a middle name, so we will leave that alone. Pin that so it doesn't do that. He was born January 1st, 2004. He is a student. All right. Here are kind of a series of questions, right? Can he be claimed as a dependent? Yes. Is he being claimed as a dependent? Yes. His parents are claiming him. Was he over 18 and a full-time student at an eligible education institution? Yes. He is not blind. He is not dead. He does not want to give money to the presidential election campaign. Although you should know, right, this is not actually like subtracting from your refund or increasing your taxes. It's basically just saying, yes, of the taxes I paid, send $3 to help candidates fund their election campaigns. There's no combat zones, no natural disasters, no digital assets. So if somebody did buy, sell, or receive, or dispose of any digital assets, they would be clicking that button there, but he did not. He likes English just fine, so he doesn't click anything there. And we enter his address, which was number 432 Elkstone Hall. Actually, that's probably the apartment number. That's 472 Stone Hall, 170 Locust Street. Zip code 28608. The software looks it up for us. Yay! So we don't have to worry about it. All right. So his parents live in Charlotte, North Carolina, and he is going to school in Boone, North Carolina. So he is going to be a resident of North Carolina. So that's what we're going to leave here. We will talk more about state residency in late January, early February. A phone number is required, so we will put in a fake number. Obviously, this one isn't real. When our clients actually are using the software, we would want them to put in their real number. But for us, we're going to use a fake number. We're not going to do any other emails or anything like that. We're not going to invite customers to portals. That is a traditional model option only. All right. Uh-oh, +4 should be something. Where is it unhappy? Oh, that's where it's happy. Okay, let's try that. There we go. All right, do we have any dependents that we can claim on your return? No, right? He is not supporting anybody. He is not even supporting himself. All right. So Jacob, if you remember, he received a W-2. So we are going to enter his W-2. All right, it looks like a standard W-2, right? It doesn't say like W-2C for corrected. Doesn't say anything about a railroad. So we're going to enter the information, 56.117.6030. App state is already there because we used this in the past. All right, so that's got that information about the employer. It copies over the information here from Jacob. Now, and it doesn't matter. It's totally fine if his W-2 has like a different address than where he's living right now. That's okay, right? That's just basically the information that the university had or his employer had about him when they prepared that form. People move all the time. It's no problem. When we do the return, we're going to put his actual real mailing address in there. And that's completely fine if this is different. Okay, so box number 1. So I am going to literally like be copying from, oops, here. Box 1, 5200, box 2, 180, box number 3, 4. We're going to just copy and paste what those have. All right, so 5200. All right, and the software is a little bit smart. It's going to say, oh, we think it should be 5200 over here as well. And it's going to do some automatic math to say, theoretically, what it should have been taken out for Social Security and Medicare taxes is this amount right here. Now, if reality is different, right? If that W-2 form has something else on it, we are going to put whatever that W-2 form has. Sometimes students will have 0 in these boxes, and that's totally fine. They might be exempt from Social Security and Medicare taxes because they're working while they're going to school. Totally cool. All right. he paid or had $180 taken out for federal taxes. So we'll put that here. All of his other boxes are mostly blank until we get down to the very bottom. Nothing in 12 and 13, nothing in 14. Now we're into 15, so that's our state information. So his state was NC for North Carolina. We'll find that. It copies those state wages over. Again, right, we could change it if we needed to. We need an employer state ID number. Need one more zero. There we go. All right. Box number 16 from the W-2, box number 17 from the W-2 is 90. North Carolina doesn't have that local wages and income tax, so we don't have to put anything there. Now, if he worked for this company and he worked in another state, then he might have another state. That happens sometimes with companies, with people that work on the East Coast because the states are so close. They might work at a New York office and work at a Philadelphia office, or maybe they transferred, right? They were located in Alabama and they came up to Minnesota. So half of their wages are taxable in Alabama and half of them are taxable in Minnesota. So that can definitely happen. And that would be what we would do right there. But that's all that we have for Jacob. It's very simple, right? Life is pretty easy for Jacob. All right, we're gonna say continue. All right, these are some of the many types of forms that we have, right? If there was other income, here's even more types of forms where we might possibly have it. And yet again, even more types of income that we could have, right? So when I say that there's a type of income, there's a form for it, I'm really serious about it. They've got forms for all kinds of stuff. But for Jacob, he doesn't have anything like that, right? Life is pretty simple. He has a W-2. That's all he's got. No other types of income. All right. He doesn't have any of these adjustments, right? We can look at them to be sure, but right, he doesn't have any educator expenses, no health savings accounts, no retirement savings, no penalties on withdrawals, no contributions to retirement accounts. He's not paying for any student loans, doesn't have any of that stuff. Likewise, ooh, look at that. See, they're working on it. No tax on overtime, no tax on tips. So I suppose we could ask Jacob, hey, Jacob, did you pay or did you get paid any overtime at all? Did you ever work more than, 40 hours a week? And Jacob says, no, as a student, I had to keep my hours less than 20 hours per week. So I never got any overtime. And we say, okay, that's fine. Hopefully, if the answer was different, he would come in with some sort of a statement from his employer saying, okay, yes, actually I did. And, I had $500 of qualified overtime. Hopefully that will be the case for us. All right. So no additional deductions. No standard deductions. Let's see, right? So it's automatically calculated, right? We don't have to do any math. We could enter itemized deductions. If any of those things applied, this would be where we'd go. None of that does. We don't have any credits. We're going to talk about that next time. For now, Jacob, very simple. No other taxes. We can just continue. No other payments that he's made. No other miscellaneous forms. He did not have insurance under the Affordable Care Act. He was still on his parents' insurance, which was super good for him. We can't do any states yet. And we're done. Hypothetically, we're done. I'm going to view print. Let's take a look at Jacob's return. All right. So when we get our returns from TaxSlayer, they always look like this, right? It's got kind of a cover sheet that talks about, hey, here's all of my forms, right? This software is a commercial software. So yes, they signed the deal with the IRS to provide it for the VITA sites, but they also sell it to like accounting firms and CPA firms. So those firms can like go in and say, all right, well, like a 1040 is like $250. And then like this other form is this amount, the other form is this amount, and they can like do this invoice with real numbers for people that actually get charged. So for us though, it's all blank, it's all good. Summary information about filing status, income, all of that kind of stuff. Here are the income documents that you entered, the W-2. This shows your information here. This is a really good place to double check to make sure you got everything correct, right? I deleted the Social Security and Medicare wages and tax withheld that was on the example in the presentation. But you know, for you, you would want to just always make sure like whatever's on that form is what we want to put in there. All right. E-signing form, we won't need to worry about that, but this is what it looks like. And here's our tax form, finally, right? It says, hey, congratulations. Here I am, I'm Jacob. This is where I live. I'm a single guy, right? I have no dependents. I have no digital assets. I had $5,200 of wages is all I really had. Nothing else, no other types of income. That was my total income. I had no adjustments, so my adjusted gross income was 5,200. All right, somebody else can claim him as a dependent. So my standard deduction, right? Earned wages plus $450 up to that kind of regular standard deduction amount. So his standard deduction is $5,650. So that means he doesn't have to pay any tax, right? Which is fabulous. And so because he's under the standard deduction amount, theoretically, he is not required to file, right? He doesn't owe any tax, but he absolutely should file because he's already paid a bunch of tax, right? He's paid 180 bucks in federal tax and he's paid $90 in North Carolina tax. And he's gonna get all of his federal money back. He may get most or all of his North Carolina. So he definitely wants to file, right? The government has his money, let's get it back for him. So that's what this says here, right? You paid 180 bucks. You overpaid by 180 bucks. You want all of that money back, right? You don't have to get all of that money back. You can say, oh, keep it for next year, apply that for 2026 estimated tax. Very rarely happens, but could theoretically happen. Otherwise, you know, give me my money back. And one of the other really fun things that the IRS changes have been made is, right, basically that they will not send paper checks anymore. So the way that they want to provide a refund is through a direct deposit to an account, a bank account that's in the United States. That's either a checking or a savings account. Now, there are supposed to be some alternatives or exception processes for people that don't have a bank account. None of those have been like defined yet, so we have no idea like how to request an exception to get a paper check, or like will they send you like a debit card, or the details on that part are not clear at this point in time. As we find out more, obviously we'll definitely be letting all of the volunteers know, and then of course all of our taxpayers as well. But that's the basic form. He would, if he's in a paper file, he would physically sign right here, your signature. Otherwise, when he electronically files, he'll click a button and it will electronically apply a code and then send it off. This is giving him the itemized deduction form, even though he is not itemizing. And then here's some like random history information of like all of that stuff, the worksheets. All right. And so that is Jacob's practice tax return. So I'm going to go back to here. So they give you a little preview here. Sometimes this preview is off, especially when they're updating things. That's why I went view print, and then you can download a PDF of it. So when you're doing that for practice returns, that's what you're going to do is go view print, it'll download the PDF, and then just send me that whole PDF. You don't need to worry about like only some pages being included. Just send the whole thing. Perfectly good. All right, so let's come back to this. All right, so we were here. So any questions about TaxSlayer? All right, so if you have questions and you are feeling like you don't want to ask them in front of the whole group, I would encourage you to feel free to just shoot me an email. So it's at that volunteer@nrtaxhelp.org. So I am generally in that large percentage of the day. And so I can help answer your questions or try to explain things further or different words or give you a different example or two if you have any questions about any of the material. All right, so that is the end of training for today. So let's talk about this. Remember, we have Moodle. So we had 2 quizzes. So we already had modules 1 to 3. There was an income quiz, info and quiz. And then now there's going to be another adjustments and deductions quiz. So I will go back through that. I can't remember if I think I have it set up to be accessible tomorrow. I will check that either later tonight or first thing tomorrow morning and release that to everybody so that you guys can work on that one as well. All right. And with that, I am going to stop the share and I'm going to stop the recording.